Hey guys, today we are taking a look at Bristol Myers Squibb. This company is a leading global biopharmaceutical company dedicated to discovering, developing, and delivering innovative medicines that help patients prevail over serious diseases. With a strong focus on oncology, hematology, cardiovascular disease, immunology, and neuroscience, BMS combines the resources and expertise of a large pharmaceutical company with the agility and innovation of a biotech firm. Why are we interested in the company? They have growth drivers which can potentially increase cash flows from 2025 onwards. They have good dividends at around 5% and the share price has fallen to reasonable levels, and we think that this could be a potential investment opportunity for both dividends and share price gains. The prices have dropped because of concerns about loss of patent to their blockbuster drugs Eliquis and Revlimid. But the company is positioned to take advantage of advances in biotechnology by acquiring innovative startups with drugs in phase 2 trials. To highlight this point, they acquired Karuna Therapeutics and Mirati Therapeutics last year. Both the companies have drugs which could be brought to the market in reasonable time to be able to participate in the revenues. Bristol Myers trades on NYSE. It is currently trading at a share price of $49.36. The 52-week range is $63.39. They made a loss in the last quarter, and so we do not have a PE ratio. The current dividend yield is about 4.89%. The market cap is about $100 billion. When we look at the Bristol Myers Squibb chart, the price went below the 5-year low formed in 2019 at around $40 and has since bounced. The price is trading above the 20-week EMA and is currently trading around the 50-week EMA. The last lower high is at $54.82. When comparing Bristol Myers Squibb stock with the S&P 500, we can see that the stock has underperformed significantly compared to the broader market. However, lately it is starting to show some relative strength. Most of this presentation is from their Q2 earnings release. But this will also include Muffet's take on the stock. Company strategy. The company wants to specialize in focused areas where they have a competitive advantage. Their biggest ones are immuno-oncology and cardiovascular, and from this year on neuroscience after the acquisition of Karuna Therapeutics. For the second quarter of 2024, the sales was $12.2 billion, up from $11 billion in 2023. The gross margin was 73% and the diluted EPS was 0.83. If we look at sales over the years, we can see that the sales jumped in 2020 from 2019. This is because they acquired Celgene and MyoKardia. But the sales have stagnated over the last 3 years at around $45 billion. If we look at the liabilities, they have a total liability of $43 billion, which is quite high in our view. However, the positive flip on this is that the liabilities have fallen from its high of $61 billion in 2020. By contrast, Roche, which is another biotech company that we like, has a market cap of $220 billion and their debt is only $24 billion. The increase in debt is mostly due to the acquisition spree that the company got into from 2019 onwards. We will discuss this later. Let's get back into the earnings for this quarter. For the quarter, the growth portfolio contributed to $5.6 billion of the $12 billion in revenues. Some of their drugs in their growth portfolio achieved some impressive sales growth. Sales of Breyanzi and Opdualag grew 53%, Reblozyl 83%, and Sotyktu greater than 100%. They have obtained US FDA approval for subcutaneous nivolumab, which can potentially extend the durability of the business segment. Cardiovascular. Their main product here is Eliquis, apixaban. Their revenues from this alone was $3.4 billion with 7% year-on-year growth with strong performance in the US. It is one of the top oral anticoagulants in some countries. However, it has lost its patent in the UK and some European countries, and this will result in reduced revenues from generic competitors. We will cover this problem of the company later in this video. Oncology. Their biggest seller is nivolumab, which is a therapy given for a variety of lymphomas. Their revenues from this drug is $2.3 billion with 11% year-on-year increase. Another one on note in the oncology segment is Opdualag, which is used for the treatment of advanced melanoma. The sales increased 53% year-on-year. Hematology. They have several drugs in this segment, and the biggest revenue generator is Revlimid, which is used for treatment of multiple myeloma, lymphoma, and myelodysplastic syndromes. But revenues decreased 8% year-on-year. Between 2022 and 2023, the sales of Revlimid decreased nearly 40% from nearly $10 billion to $6 billion due to loss of patent and competition from generics. This is one of the main reasons why the stock is underperforming. Immunology. Here the biggest revenue generator is Orencia, which is used to treat moderate to severe rheumatoid arthritis and juvenile rheumatoid arthritis. The sales grew 2% to $943 million. Another drug, Sotyktu, which is used for psoriasis, has seen sales growth of 26%. Growth pipeline. They have several growth catalysts from 2025 to 2026. There are indication expansion for some of their products and other products which are in early trial phases. All of these would increase their revenue growth in the future. Acquisitions. Bristol Myers Squibb has been in acquisition mode since 2019. They acquired Celgene in 2019 for $73 billion, and if debt was included, the total deal was worth $93 billion. Their main product was Revlimid, which had sales of about $10 billion a year. We think that this was a bad deal, because Revlimid came off patent in 2022, and as we can outlined earlier, the sales fell 40% from 2022. We still can't understand why a company would pay $93 billion for a company which has a blockbuster drug providing revenues of $10 billion per year but will come off patent in 3 years. They also acquired Myocardia in 2020 for $13 billion. They have brought their drug into the market called Camzyos, which is the only drug available for the treatment of hypertrophic cardiomyopathy. In 2023 alone, they made 3 acquisitions including Karuna Therapeutics, Mirati Therapeutics, and Rayzebio. The total value of the deal is about $24 billion. This is one of the reasons why they have a bloated balance sheet. They are planning to reduce the total debt by $10 billion and by $3.1 billion in the second quarter alone. They also have $5 billion available to buy back shares. We would prefer that they use this to reduce leverage rather than buy back shares. We think that this is the management's attempt to hide the falling revenues at Bristol Myers Squibb in 2024 to 2026 period due to loss of patents. In fact, according to Fierce Pharma, Bristol Myers Squibb is at most risk of loss of revenues due to patent expiry. 3 of their blockbuster drugs, Eliquis, Revlimid, and Opdivo, will come off patent around 2026 to 2028 period. This is one of the reasons why they have gone on an acquisition spree. Revlimid expires fully in 2026, but some of the patents expire in 2022, and the generic makers have started producing Revlimid under a licensing deal with Bristol Myers Squibb. Eliquis, the patent expires in 2027, but there are already generics in the UK and many European countries. Thanks to settlements and a key lawsuit, they have been able to fend off cheaper rivals until 2026. Opdivo, the drug patent expires in 2028 and contributes to $9 billion in sales. They have guided low single-digit revenue growth for 2024 and the EPS will be between 60 cents to 90 cents. The Muffet take. One of the reasons for the big share price falls would be due to concerns about loss of patents of blockbuster drugs and the bloated balance sheet. The drug most at risk is Revlimid. Although Bristol Myers Squibb gets the majority of the sales from the US, the $6 billion in revenues may be relatively safe until about 2026. Eliquis has until 2028, although regulatory changes in the US might put it at risk. Overall, Bristol Myers Squibb is at risk of losing roughly $10 billion in sales over the next 2 to 4 years. To compensate for this, they are banking on the growth portfolio, which comprises Reblozyl, Opdualag, Camzyos, Breyanzi, and Krazati. The revenue from this portfolio increased 21% on a constant currency basis. They have US FDA approval to market KarXT, which is a muscarinic drug, to be used in schizophrenia. The company is also hoping to get approval to use the drug for Alzheimer's agitation and Alzheimer's psychosis. Both have multibillion-dollar potential. They have ongoing studies which will expand the use of the growth portfolio for other indications between 2025 to 2026. How much the company can expand the indication will determine the revenue growth to compensate for the fall in revenues from the blockbuster drugs. We think that the share price falls have made Bristol Myers Squibb to be slightly attractive at current levels. We should watch how the sales of KarXT performs over the coming quarters, which will determine their revenue growth. Just watch what Mr. Berner, the CEO, had to say to Mad Money host Jim Cramer on Celgene acquisition.
It generated a lot of cash and it also gave us a really exciting pipeline. You know, we've gotten a number of important drugs from that Celgene acquisition. And I'll say one other thing, Jim. We're not only focused on bringing really exciting individual assets, we're focused on platforms. And the Celgene acquisition gave us 2 super exciting platforms. Cell therapy, we've established a leadership position in hematology. We're going to take that technology now and be a leader in treating autoimmune disease. protein degradation. The first generation of cell mods have transformed multiple myeloma. We're going to take that now. We're seeing exciting data in solid tumors and potentially other disease areas. So the new Bristol, as you described, is not just about individual assets. It's looking at platforms that can treat and hopefully provide meaningful improvement to patients' lives across indications.
Here is what he had to say on the acquisition of Mirati Therapeutics and Karuna Therapeutics.
There's a unique mechanism of action here. It targets M1 and M4. That's really unique. And what that gives us the ability to do is to deliver really good efficacy without the side effects that you see with these atypicals. And the side effects have really been a rate limiter. So we see the potential initially with schizophrenia, adjunct schizophrenia, which is combination use with atypicals. Those are really big opportunities for patients. Where we're playing today as a company, we have depth in oncology and cardiovascular disease. And as we look at the acquisitions you just highlighted, they give us additional depth in oncology. We are heavily indexed in immuno-oncology today, but if you look at Mirati, it gives us a nice entree into targeted therapies. And with Raise Bio, we are getting an acquisition that gives us the potential to bring in radiopharmaceuticals, which is one of the fastest growing platforms in all of solid tumor oncology. We love the technology from this company and look forward to completing that acquisition as well.
Now, if it had not been for the huge debt, we would be very bullish on this stock. The debt makes it a little bit risky and we have to wait on the performance of the growth portfolio. We also think that Bristol Myers Squibb will acquire other early-stage biotech companies next year to take advantage of the advances in biotechnology. On this basis, we would say that it is a moderate buy only. We have this in our model portfolio. But we will acknowledge that it is a risky bet. We will hold on to the stock only based on the stock performance over the coming weeks. We need to see the relative strength of the stock holding up during the volatility associated with the US elections. If that was the case, then we will continue to hold. If not, we will exit the stock. We hope that this analysis was useful. This is much more comprehensive than many of the analyses on Bristol Myers Squibb on YouTube. Please